Before we begin, there is one important thing you need to understand. This video is created for learning and educational purposes only. No trading setup is guaranteed to work 100% of the time. Before using real money, understand the concept, practice on charts, and always follow proper risk management. If I told you that a single candle can help you understand the battle happening between buyers and sellers, you might not believe me. But that is exactly what a candlestick can show you. The problem is that beginners go online and learn 20, 30, sometimes even 50 different candlestick patterns. Then they open a real chart and become even more confused. So in this video, we are going to keep everything simple. I will explain only 6 important patterns, but we will not just memorize their names. We will understand what buyers and sellers are actually doing behind each pattern. But before we move to the patterns, one basic concept must be completely clear. If you do not understand the candle itself, you will never properly understand the pattern. In simple words, a candlestick shows the complete journey of price during one specific period of time. If you are using a 1 hour chart, one candle tells the story of one full hour. On a daily chart, one candle tells the story of an entire day. Now, a beginner might ask an obvious question. If a simple line chart already exists, why should we use candlesticks? Because a line chart mainly shows the closing movement. A candlestick tells us where price opened, how high it went, how low it went, and where it finally closed. Imagine price reaches a support level. On a line chart, it may look like price simply touched the level and moved back up. But the candlestick chart may reveal that price actually moved below support, created a long wick, and then buyers strongly rejected those lower prices. Now let us keep it very simple. A green candle means buyers managed to close price above the opening level. A red candle means sellers managed to close price below the opening level. Every candle has two main parts, the body and the wick. The body shows the main movement, while the wick tells us where price traveled but could not stay. If a green candle has a very large body, the simple meaning is that buyers gave sellers very little room to fight back. Buyers aggressively pushed price higher. The opposite is true for a large red candle. It tells us that sellers created strong pressure and pushed price significantly lower. But what if the candle body is very small? That means the fight was much closer. One side may have won, but it did not clearly dominate. Now focus on the wick, because this is where candlestick psychology starts getting really interesting. Price moved down. Sellers looked strong. But suddenly buyers stepped in, rejected the entire downward move, and pushed price back up. That is why a long lower wick was created. With an upper wick, the story is reversed. Buyers pushed price higher, but sellers rejected those higher prices and pushed the market back down. If the candle has a small body and both wicks are almost equal, the market is basically telling us that buyers and sellers are both fighting, but there is no clear winner yet. Now you understand the basic language of a candle. So let us move to the 6 patterns that combine this language and tell us an even clearer story. Pattern number 1 is the engulfing pattern. The name sounds difficult, but the concept is simple. One candle completely covers the body of the previous candle. Imagine the market is in a downtrend. The first red candle shows that sellers are still strong, but then a large green candle appears and completely covers the previous red candle body. The important thing here is not just the candle color, it is the shift in control. Sellers had control, and then buyers took that control away from them. A bearish engulfing pattern tells the opposite story. Buyers were strong, but then a large red candle appears and sellers begin taking control. But this is where beginners make a big mistake. They see any engulfing pattern and immediately enter a trade. The pattern matters, but where the pattern forms can matter even more. By the way, if you like this style of learning where we do not just memorize patterns but actually understand the logic behind the chart, you can join our Telegram learning community. I will share educational chart examples and trading learning material there. The link is in the description. Pattern number 2 is one of the easiest concepts for beginners, the pin bar. It is only one candle, and if you already understand wicks, you already understand most of its story. In a bullish pin bar, sellers aggressively push price lower. Then buyers step in, reject those lower prices, and push the candle back up before it closes. Now the question is, a pin bar formed, so should we immediately buy? I would not rush. If the next green candle also confirms buyer strength, the setup becomes much clearer. In a bearish pin bar, buyers push price higher, but sellers reject those higher prices and push the market back down. Think of pattern number 3 as a very short story. Strong move, small break, and then another strong move in the same direction. The first strong green candle shows buyer strength. The small red candle in the middle may simply be a temporary pullback. Then the third strong green candle shows that buyers are still active. In the bearish version, the same story happens on the seller side. Strong red candle, small green pullback, and then another strong red candle. Now do not confuse pattern number 4 with continuation. In this pattern, the third candle changes the entire story. In a downtrend, first we get a large red candle, then a smaller red candle. That may show selling momentum beginning to slow down. Then suddenly a strong green candle appears and buyers show serious strength for the first time. In an uptrend, the story is reversed. Strong green candle, then a weaker green candle, and finally a powerful red candle. Buyer strength begins fading and sellers step in. Pattern number 5 is probably the easiest one to see visually. The market spends some time unable to decide where it wants to go, and then suddenly one side explodes out of the range. These small candles are called consolidation. Buyers and sellers are temporarily balanced. Then a strong green candle closes above the range. Now we have clear evidence that buyers have broken that temporary balance. If a strong red candle breaks below the range, control may be shifting toward the sellers. Pattern number 6 is very interesting because sometimes the market begins giving us a warning before the actual reversal happens. In a downtrend, red candles are still forming, but notice something important. Every new candle is smaller than the previous one. Price is still moving down, but seller strength is slowly fading. Then a strong green candle appears. This can show buyer strength entering the market and may provide additional evidence of a possible reversal. In an uptrend, if green candles gradually become smaller and then a powerful red candle appears, the story becomes the opposite. By now, the 6 patterns should make sense, but the most important part of this video starts right now. Because identifying a pattern is easy. Understanding whether that pattern is forming in the right market context is the difficult part. The same bullish engulfing pattern may have less meaning if it forms randomly in the middle of the chart. But if that same pattern forms at an important support level, the context becomes completely different. Location can mean support, resistance, a trend line, Fibonacci, or another important key level. Another common beginner mistake is treating every small candle on a very low time frame as a trading signal. On higher time frames, such as 1 hour or above, the market structure may appear much cleaner. Now let us stop talking about theory and turn this into a simple 3-step process that a beginner can follow when opening a chart. Step 1. Find an area where price has already reacted multiple times in the past. Step 2. Allow price to come back to that area. Do not chase the market. Patience is also a trading skill. Now price touches support. The beginner's first thought is usually BOE, but we are not entering yet. Instead, we watch what the candles are telling us at support. Are sellers getting weaker? Are buyers showing rejection? Is a bullish pattern beginning to form? Now we get a large red candle, then a smaller red candle, followed by a powerful green candle. This is a bullish 3 bar reversal. More importantly, it did not form randomly, it formed directly at support. Now let us go one step further. When 2 or 3 different reasons support the same area, traders often call that confluence. Imagine an area was previously acting as support. Price breaks below it. Later, when price comes back from underneath, that old support can begin acting as resistance. Now imagine a descending trend line is also reaching exactly the same resistance area. We now have 2 separate reasons pointing toward the same location. But we still do not blindly sell. Price reaches the area, green candles gradually become smaller, buying pressure begins fading, and then a strong red candle appears. Now sellers are giving us additional confirmation. If these practical chart breakdowns are helping you understand price action and you want to see more learning examples regularly, you can join our Telegram community. The main focus there is learning and understanding charts. The link is in the description. Before we finish the video, let me answer some common beginner questions very quickly. Does every engulfing pattern work? No. A pin bar formed, should you enter immediately? No. Long lower wick, lower price rejection. Long upper wick, higher price rejection. What is the best pattern? the one that aligns with the correct market context, location, and confirmation. Quick recap. Engulfing means a possible shift in control. Pin bar shows rejection. 3 bar continuation may support continuation. 3 bar reversal may signal a possible direction change. Breakout candle shows a range being broken. Shrinking candles show momentum weakening before a possible reversal. If you remember only one thing from this entire video, remember this. Memorizing the name of a candle is not trading. Understanding the story between buyers and sellers behind that candle is trading analysis. On a chart today and manually find these 6 patterns. Take screenshots. Check where the pattern formed, which level it formed around, and what price did afterward. This type of practice is what improves chart reading. Now tell me one thing in the comments. Out of these 6 patterns, which one was the easiest for you to understand and which one was the most difficult? This video made candlesticks easier for you to understand. Like the video, subscribe to the channel, and if you want regular educational chart learning, the Telegram community link is available in the description. See you in the next video. Until then, do not just look at the chart. Try to understand the story behind it.